Now let's move to the U.S. now, where stock futures moved higher on Thursday, setting the Dow on course for its fifth consecutive rally as the equity market keeps rebounding from its tumble earlier this month. Looking at the futures numbers now, the Dow Jones futures rose by 1% to 25,123, while the S&P 500 futures added 0.7% to 2,715.75. Nasdaq 100 futures also climbed by 0.7% to 6,735.5. Let's get more details from Jill Malandrino, global market reporter at Nasdaq, reporting from the Market Square in Times Square.
Good afternoon, I'm Jill Malandrino, global markets reporter at Nasdaq, with an update on what has been a volatile February that saw equity markets slip into a correction defined as 10% or more drop from a recent high for the first time since February 2016 as volatility soared, trading volumes surged, and stock prices plunged. The initial catalyst was higher than expected wage growth in the January jobs report, which increased fears that inflation would accelerate and that the Federal Reserve would be more aggressive in 2018. These developments caused the market's so-called fear gauge, the VIX, the volatility index, to more than double at the most stressful points last week, further accelerating selling pressures. Markets appear to have started the consolidation process in just 6 days as the major averages recouped some territory, and that leaves traders asking whether or not this is the end of the correction. Now, LPL Financial points out that what hasn't made as many headlines over the past week is that economic and earnings data have been quite strong, indicating that the market sell-off is detached from the fundamentals, making the correction normal and healthy. Now, the key data that traders will be watching going forward will all be tied to inflation and jobs, like the consumer price index. We saw that come out this morning, and since it was better than expected, we saw that significant drop in futures just to watch it come nearly in the green at the open of trading at 9:30 a.m. Eastern. We're also going to look at producer price index and, of course, all the employment reports, as well as movement in the dollar and commodities. The more growth these data show, the more skittish markets can be due to interest rate concerns.